$9 trillion, moving silently, no headlines, no press conferences, no market panic. Just the largest capital reallocation in human history happening in complete darkness. Ladies and gentlemen, I need you to understand what I'm about to tell you. While the world watches stock market fluctuations and debates interest rate policies, $9 trillion in institutional money has begun moving. Not trading, not speculating, moving permanently, away from the systems that built the modern financial world. This isn't money market funds shifting between treasury bills. This isn't hedge funds rotating sectors. This is foundational capital, the bedrock money that supports entire economic systems, quietly exiting positions that have been stable for decades, and almost nobody's talking about it. The $9 trillion figure comes from proprietary data collected by the Bank for International Settlements, information that's shared only with central bank governors and finance ministers, data that tracks cross-border capital flows, institutional asset reallocation, and sovereign wealth fund positioning, data that tells a story the public markets haven't figured out yet. What makes this figure so extraordinary is its composition. This isn't hot money speculative capital that moves based on interest rate differentials or currency fluctuations. This is what institutional investors call patient capital, pension funds that invest for 30-year horizons, sovereign wealth funds that think in generational terms, insurance companies that need to match long-term liabilities with stable assets. When patient capital moves, it doesn't move back. Pension funds don't day trade their asset allocation. Sovereign wealth entities don't change strategic direction based on quarterly earnings reports. When these institutions reposition $9 trillion, they're making permanent structural changes based on fundamental analysis of long-term economic trends. The velocity of this movement is unprecedented in financial history. During the 2008 crisis, institutional reallocation took 18 months to reach peak volumes. During the COVID crisis, major portfolio shifts occurred over 6 months. This $9 trillion rotation has happened in 8 months. The smart money isn't just moving, it's running. Here's what's happening. Global institutional investors, the pension funds managing your retirement, the insurance companies backing your policies, the sovereign wealth funds representing entire nations, they're all doing the same thing simultaneously. They're reducing their exposure to dollar-denominated assets, European government bonds, and traditional safe haven investments. But they're not panic selling. They're not creating market volatility. They're doing something much more dangerous. They're quietly rotating into physical assets, foreign real estate, commodity-producing infrastructure, and alternative currency systems. They're building positions in the post-dollar world while the dollar world still thinks everything is stable. The Norwegian government pension fund, the world's largest sovereign wealth fund, has reduced its U.S. Treasury holdings by 42% over the past 18 months. Not sold, reduced. They're allowing bonds to mature without reinvesting the proceeds in American debt, a $1 trillion holder walking away slowly, methodically, without creating headlines. The Japan Government Pension Investment Fund, managing nearly $2 trillion in retirement assets, has quietly shifted 12% of its portfolio from government bonds to real assets. Infrastructure projects, commodity storage facilities, agricultural land. They're not chasing yield. They're chasing inflation protection in a world where currency stability can no longer be assumed. But the most telling move comes from an unexpected source. The Catholic Church's financial holdings, managed through the administration of the Patrimony of the Apostolic See, have been systematically converting liquid assets into physical property across 5 continents. When an institution that thinks in centuries starts preparing for currency instability, the message is clear. The China Investment Corporation has been the most aggressive. Over $800 billion in assets under management, and they've been quietly purchasing controlling stakes in mining companies, energy infrastructure, and agricultural operations across 3 continents. Not investing, acquiring. Building supply chains that exist entirely outside Western financial systems. But China isn't working alone. The China Investment Corporation has been coordinating with the Abu Dhabi Investment Authority, Singapore's GIC, and the Kuwait Investment Authority to avoid bidding against each other for strategic assets. They've created what insiders call the Alternative Asset Alliance, an informal coordination mechanism for acquiring physical infrastructure without triggering Western regulatory scrutiny. The numbers are staggering. In the past 8 months, this alliance has acquired 43 mining operations, 67 energy facilities, over 200 agricultural properties, controlling interests in critical infrastructure across 4 continents. They're not building investment portfolios, they're constructing parallel economic systems. The most telling acquisition happened 3 weeks ago. The Alternative Asset Alliance purchased a majority stake in Baltic Dry Shipping, one of Europe's largest maritime transport networks. They didn't buy it for financial returns. They bought it to control the physical movement of commodities between Europe, Asia, and the Middle East. When sovereign wealth funds start buying shipping companies, they're preparing for trade wars fought with cargo containers instead of currency swaps. What they all know, what they're all positioning for, is the end of the monetary order that has existed since 1971. The end of the system where central banks can create money without consequences, where governments can issue debt without limits, where paper assets are treated as permanently valuable stores of wealth. The trigger isn't a single crisis. It's mathematical inevitability. Total global debt has reached $307 trillion. That's nearly 4 times global GDP. The interest payments alone on that debt exceed the economic output of entire continents. The system has reached the point where debt can only be serviced by creating more debt, which requires creating more money, which destroys the value of all existing money. Smart institutional money sees the endgame. They understand that when the mathematical limit is reached, and it's being reached now, there are only 2 possible outcomes: hyperinflation or deflationary collapse. Either paper money becomes worthless through oversupply, or the debt bubble bursts and destroys the credit system entirely. Both outcomes are catastrophic for traditional financial assets. So they're moving, not into other paper assets, which face the same fundamental problems, but into things: real assets, productive assets, assets that will retain value regardless of what happens to currencies or credit markets. The commodity markets are already reflecting this institutional flow. Oil storage facilities, copper warehouses, agricultural processing plants, all seeing unprecedented investment from pension funds and sovereign wealth entities. They're not speculating on commodity prices. They're securing physical control over the resources that maintain human civilization. But the most significant moves are happening in real estate markets that most people never see: industrial real estate, port facilities, manufacturing complexes, distribution centers. The infrastructure that supports global trade is being quietly acquired by institutional investors who understand that economic systems may change, but physical infrastructure retains value. American pension funds are experiencing a crisis they don't want to discuss publicly. The California Public Employees Retirement System, managing over $500 billion, has seen foreign institutional co-investors withdraw from major U.S. real estate projects for the first time in 20 years. European pension funds are refusing to participate in American infrastructure deals, citing currency risk concerns. Meanwhile, those same European institutions are partnering with Middle Eastern sovereign wealth funds to purchase American industrial facilities directly. They're not buying real estate investment trusts or property funds. They're buying the actual factories, warehouses, and processing plants that form the backbone of American manufacturing. The Texas teachers' retirement system recently discovered that a consortium of foreign institutional investors had quietly acquired controlling interests in 17 facilities that process oil, natural gas, and agricultural products across Texas. The foreign buyers included pension funds from Norway, Denmark, and the Netherlands, working alongside sovereign wealth entities from Qatar and Singapore. They paid cash, avoided financing, and completed transactions designed to minimize regulatory scrutiny. When foreign institutions start buying American productive capacity with cash, while American institutions struggle to find domestic investment partners, the wealth transfer isn't theoretical anymore. It's operational. The infrastructure that supports American economic activity is being systematically acquired by institutional investors who are hedging against American economic decline. European pension funds have been purchasing manufacturing facilities across Eastern Europe, Asia, and South America, not to operate them, but to own the productive capacity. When currency systems become unreliable, the entities that control actual production become incredibly valuable. Middle Eastern sovereign wealth funds are buying agricultural land across Africa, South America, and Australia. Entire farming operations, water rights, food processing facilities. They're not investing in agriculture. They're securing food security for populations that may face supply chain disruptions during monetary transitions. The $9 trillion represents more than portfolio reallocation. It represents the smart money's vote of no confidence in the entire post-war financial system. These institutions manage the retirement savings of millions of people, the insurance reserves that protect against catastrophic loss, the sovereign reserves that nations depend on during crises. When they collectively decide that traditional safe assets are no longer safe, when they simultaneously begin positioning for a world where paper currencies may lose their purchasing power, they're sending the strongest possible signal about what comes next. But here's what makes this movement so dangerous. It's creating the very instability it's trying to protect against. As institutional money flows out of government bonds, yields rise. As demand for traditional safe assets declines, their prices fall. As sovereign wealth funds dump dollars for physical assets, dollar strength weakens. The Federal Reserve can print money to buy treasury bonds and keep yields artificially low. The European Central Bank can create euros to purchase government debt and maintain artificial demand. But they can't print oil fields. They can't create agricultural land. They can't manufacture the physical assets that institutional money is rotating toward. This creates a feedback loop that accelerates the crisis. The more money central banks print to support traditional asset prices, the more attractive physical assets become as inflation hedges. The more institutional money flows into physical assets, the higher their prices rise, making paper assets look even less attractive by comparison. Central bank governors understand what's happening. Internal Federal Reserve documents, leaked through congressional banking oversight committees, show that Fed officials are tracking institutional flows and growing concerned about what they call duration risk. Not the duration of bond portfolios, but the duration of dollar dominance itself. The Federal Reserve's internal weekly reports now include a section called Global Institutional Positioning Analysis. These classified briefings track which major institutional investors are reducing dollar-denominated holdings, which sovereign wealth funds are increasing commodity exposure, and which pension systems are diversifying into non-Western assets. The trend lines in these reports show accelerating institutional exodus from traditional safe assets. The Bank of Japan has been conducting stress tests of scenarios where foreign institutional demand for Japanese government bonds drops by 50% over 2 years. Not sudden selling, but gradual rotation away from yen-denominated assets toward physical alternatives. Their models show that such a flow would make their debt burden unsustainable. European central bank officials are privately discussing what they call the infrastructure gap. The concern that European pension funds are investing more heavily in non-European assets than European development projects. The fear that European institutional money is building the productive capacity of other regions while European infrastructure ages and declines. But the most troubling intelligence comes from the United States Treasury. Internal analyses suggest that foreign institutional demand for U.S. government debt could decline by 30% over the next 24 months, as pension funds and sovereign wealth entities diversify into physical assets and alternative currencies. If foreign institutional buyers reduce their Treasury purchases by 30%, the Federal Reserve would need to monetize an additional $2 trillion in government debt annually just to maintain current interest rates. That level of money creation would trigger the inflationary spiral that institutional investors are already positioning to survive. The geopolitical implications are staggering. American military power projection depends on foreign institutional willingness to hold dollar-denominated assets. When Japanese pension funds and Norwegian sovereign wealth entities stop buying U.S. Treasury bonds, America's ability to finance overseas operations becomes constrained. Defense contractors are already reporting delayed payments from Pentagon procurement programs as Treasury funding becomes more expensive. Lockheed Martin, Raytheon, Boeing, all experiencing extended payment cycles as the Defense Department struggles with higher borrowing costs caused by reduced foreign institutional demand for government debt. When weapons manufacturers start complaining about government payment delays, military readiness begins to suffer. NATO alliance structures face similar pressures. European institutional investors are diversifying away from European government bonds, reducing the fiscal space that European governments need to maintain defense spending commitments. The institutional money that has supported Western military capabilities for decades is quietly moving elsewhere. Economic sanctions lose effectiveness when target nations can access capital from institutional investors who no longer concentrate their holdings in Western financial systems. Iranian infrastructure projects, Russian energy development, Chinese manufacturing expansion, all receiving investment from European pension funds and sovereign wealth entities that prioritize returns over political considerations. The most striking example involves Russian Arctic energy development. Despite comprehensive Western sanctions, a consortium of Middle Eastern sovereign wealth funds working alongside Asian pension systems and European institutional investors has provided over $40 billion in financing for natural gas extraction and transportation infrastructure across Siberia. The investors aren't violating sanctions technically, but they're providing capital that makes sanctions economically irrelevant. Trade relationships are shifting as institutional money flows toward productive assets in emerging economies. Countries that were previously dependent on Western institutional investment are discovering they can access capital from Middle Eastern sovereign funds, Asian pension systems, and other sources that don't require political alignment with Western governments. The most disturbing aspect of this capital reallocation is its coordination. $9 trillion doesn't move simultaneously by coincidence. Institutional investors don't all reach the same conclusions about monetary system instability independently. This level of coordinated positioning suggests shared intelligence, shared analysis, shared conclusions about what comes next. The operational mechanics of this movement reveal careful planning and sophisticated execution. Major institutional investors are using intermediary vehicles, complex ownership structures, and regulatory arbitrage to avoid triggering disclosure requirements that would alert public markets to the scale of their repositioning. The Cayman Islands Monetary Authority has reported a 400% increase in new institutional investment vehicle registrations over the past 12 months. These aren't hedge funds or private equity structures. There are special purpose vehicles designed to hold physical assets, infrastructure investments, and commodity-related operations on behalf of pension funds, insurance companies, and sovereign wealth entities that don't want their strategic repositioning to become public knowledge. Swiss private banks are reporting unprecedented demand for precious metals storage, not from individual wealthy clients, but from institutional investors seeking to hold physical gold and silver as portfolio hedges. The institutional demand is so intense that storage availability in traditional Swiss facilities has been completely exhausted. New vault construction projects across Switzerland, Singapore, and the United Arab Emirates are being funded directly by institutional clients who are securing storage capacity before they need it. The insurance industry is providing another early warning signal. Major reinsurance companies, the entities that provide insurance to insurance companies, are quietly reducing their exposure to coverage related to currency risk, trade disruption, and supply chain failure. They're not canceling existing policies, but they're not writing new coverage for risks related to monetary system instability. When the companies that insure other insurance companies start limiting their exposure to systemic risk, the systemic risk is already here. The Bank for International Settlements hosts regular meetings where central bank governors, sovereign wealth fund managers, and major institutional investors share confidential economic analysis. Recent meeting summaries, partially leaked through European parliamentary oversight processes, show unanimous concern about what they call systemic monetary risk. Private wealth management conferences in Davos, Singapore, and Dubai are reporting similar themes. Family offices managing generational wealth, institutional investors responsible for pension obligations, sovereign entities protecting national reserves, all expressing the same concerns and implementing similar strategies. When the smart money moves this decisively, this quietly, this courteously, they're not just protecting their portfolios. They're preparing for the end of the financial system as we know it. They're positioning for a world where paper currencies may lose their purchasing power, where government bonds may default, where traditional safe assets become dangerous liabilities. The $9 trillion movement isn't a prediction of financial crisis. It's evidence that financial crisis is already here, not in the headlines, not in the market volatility, but in the quiet, systematic repositioning of the institutional money that holds the entire system together. When the institutions managing your retirement savings, your insurance policies, your national reserves begin preparing for monetary system breakdown, the breakdown isn't theoretical anymore. It's inevitable, and it's already begun.